things that you have to have, accounting equation. Y'all just ignore me. Y'all just ignore me. It's like your mama say, why sit down so long? You just can't sit down. Alright. Remember that one. Assets equals liabilities plus owner's equity. Accounting equation. Something in the court, something in accounting, you have to have it. You go up to accounting 2, it's just things that you have to have. Assets equals liabilities plus owner's equity. So in those little word problems they're giving us, they might give us 2 out of these 3 components. So whatever 2 components they give you, you just solve for the third missing one. So if they give you assets and owner's equity, you subtract them to find liability. If they give you liabilities and owner's equity, you add them to get assets. How you doing, sir?
Good.
Pretty good.
Want to sit back here?
Yeah, sure. Have a seat, good sir. So y'all just keep that in mind. Whatever level you go to, you're going to have to know this formula. Assets is equal to liabilities plus owner's equity. Okay? These components of the accounting equation are housed on what statement? Balance sheet. Right? Because the balance sheet has to balance. Right? Balance sheet has to balance. The balance sheet is giving us an overview of what the company owns, what they own. Okay? Right? Accounting equation. Assets is equal to liabilities plus owner's equity. Alright? These components are housed on the balance sheet. Other things that we have to know, debits and credits. So what we're moving into now, we're just deciding which accounts we use. How does the debit, how does the credit affect the particular account that we're using? Right? So if we have cash, cash is what? An asset for the company, right? Yeah. Cash is an asset. If you want to increase cash, you do what, Mr. White? I hear you over there. You debit. Increase. So if you decrease cash, you do what? Credit. Right? Debits and credits. We have to know how debits and credits affect each account that we use in recording for financial transactions. Okay? So summarizing again, this week what we was going through was the trial balance. The trial balance.
There's something that records debit and make sure the mathematics is correct in the file.
You do double entries.
Double entry is a what in accounting?
Debit and credit.
A debit and a credit, they have to equal both sides of the balance of your trial balance has to equal.
They have to equal, right? Because double entry is an accounting principle. It states that every time we make a debit, we have to credit something else. In accounting, when you record a transaction, it's always 2 parts to it, right? Double entry, that's an accounting principle. The trial balance, a statement, like you were saying. On the trial balance, it houses all the accounts for the company or the business. It houses all the accounts. And the debits and the credits have to equal. Right? That let us know that the trial balance is right and intact when the debits and the credits equal. On the trial balance, the debits and the credits have to equal. So if I'm an accountant and I record a transaction and I debit, is that right or wrong?
No.
Wrong. You can't never do that.
Can't do double debits.
Can't do double debits. or double credits. You have to debit something and you have to credit another account. Trial balance has all your accounts on this statement and it's going to show the normal balance of debits and credits, and all the accounts on the trial balance should equal. They should always equal. Right? Owner's equity. Owner equity consists of what? Owner's equity.
That's, owner's stuff you own. Your capital, your revenue, your expenses.
Good job.
Yeah, like
There you go. Owner's equity is what I'm on. It's what I'm worth, rather. Remember? Thinking about the statements? Assets what? Assist me in making money. Assets are things that the company owns. It assists me in making money. Liabilities are things I am liable for. My bills. Okay? Owner's equity. Equity is what? What I'm worth. This is what I'm worth. So, owner's equity is essentially net income. Remember? Net income rolled over from year to year to year. Right? Owner's equity. Because net income is what I'm actually worth. As we compare the financial statements to our pay stubs, our check stub. Right? You got a gross, which is your revenue. But Uncle Sam wants a little bit. Taxes, expenses. What's the cost of doing business? Right? So revenue minus expenses gives us net income. Owner's equity. It's just a statement that tracks the net income from year to year to year to year to year. Rolls over. And then, like you said, Ms. Karen, you take into account the withdrawals or investments of the owner. He says, okay, Ms. Karen, I had $10,000 in net income left for the year. I'm going to take out $2,000. Go on vacation. What's my ending owner's equity?
$8,000.
$8,000. We have to take into account any withdrawals or investments. Okay? Net income plus or minus any withdrawals or investments. Okay? Assets, liabilities, owner's equity, debits and credits. Now we're going into statements. Trial balance. Right? We have something else that you will read about in your chapter called the chart of accounts. Chart of accounts. This used to be my favorite report. The chart of accounts. The chart of accounts lists every account that, let's say, Millamont has. It lists all of the accounts on this one chart. So now, only thing I have to do is print this report, which gives me the numbers, the chart of accounts, and then just decide which account to use. So somebody come in and they say, hey, here is $6,000 for my tuition. Here is $6,000 in cash for my tuition. We would debit what? Cash. Cash. That's revenue earned. You just paid $6,000. Or me, Bill Lamont, I just earned $6,000 in cash for your tuition. Right? So you paid in cash. So you would increase cash. Right? That money is revenue. A revenue account is in the owner's equity side. Revenue minus expenses. So I'm going to debit cash, credit my revenue account. Because of my double entry rule. Right? Double entry says that you can't only account for the cash. You have to credit the other side as well. What was the cash for? Right? What was it for? So you can look on this chart of accounts and it'll have cash account, utility expense account, equipment, rent, land, revenue for tuition, revenue for tutoring, you know, every account that you can use. That's all accounting is. It's just a sophisticated form of budgeting. That's it. Because what? External and internal users have to use the information, right? Managers want to make sure the funds and finances are being used correctly. Or the bank, right? Want to see what's our debt, what you own,
How's the business running?
how's the business running, right? How likely is it that you can repay the credit that I'm about to extend to you? Okay? So again, y'all just keep working. You just walked in on me giving an overview. They actually was supposed to be working on some work, but I told them it's hard for me to sit down, so I'm still distracting them while they're supposed to be having their interactive self-led session right now. But I'm still kind of trying to beat these principles into them right now.
Looks like you did a good enough job.
So that's what we want to always remember. The accounting equation, we gotta have it, right? We have to know what debits and credits are and how they affect accounting. Once you actually get into the workplace, you have to know where to find these accounts. So the chart of accounts, okay? The trial balance has all of the accounts listed, as well as their balance. All right? What's the other statement we have? The income statement. Remember that one? Income statement. Remember, accounting is the business language. So a lot of these things, they are just what they say. Assets assist you in making money. Liabilities are things you are liable for. The balance sheet has to balance. It shows what you own versus what you owe, right? The balance of the company. The income statement reports your income. Revenue and expenses, right? Revenues and expenses. Income statement. Right? Because revenue is not the whole picture. The wife wants to know how much of that money can we actually spend. Don't you, Mr. White?
There you go.
But we would like to beat our chest and be like, hey, I made $2,000 this week. She said, well, give me $1,500. And you say, well, my take-home pay was just about $700. Right. Revenues and expenses, okay? Net income. Net income. Okay? Chart of accounts, that's just where all the accounts are housed at. You walk into the accounting department and say, print me the chart of accounts. It's just going to show every account that the accountants here use. The trial balance will show the balance in those accounts. Okay? Trial balance will show the balance in those accounts. And remember, there are several accounts, right? Each company is different. Several accounts. It's just a way of recording things. If I got any questions, feel free. Remember, keep in mind, discussion posts are due by Wednesday. Responses are due by Friday. Homework and weekly project due by Saturday. Quiz has to be in by Sunday. Okay? Every week. We want to stay up to date. You need an extra attempt on your quiz, email me. Question?
No, I was just gonna say, what time quiz? 11:59?
Yep, 11:59 Sunday. So you want to do it in enough time in case you need an extra attempt, right?
Yeah.
So if you did it at 11 o'clock, you got through at 12, do you have time to get an extra attempt?
Depends on 11 in the morning or 11 in the morning.
Good point, Miss Karen. So yeah. So make sure you do it on time where you can actually request an extra attempt. Okay? Fire away. Alright, this is your lesson 2 quiz. Week 2, lesson 2. The lesson for this week is about the trial balance. So we're gonna go through the trial balance, also making journal entries. So a lot of the fundamental principles and things that we did last week about what's the debit, what's the credit, how do it affect assets, how do it affect liabilities. So now we're actually recording some transactions, like if you were actually an accountant for a business or a firm. So go ahead and get us started, Mr. Coates. Mr. Coates is our quiz taker for today, so he's going to be reading the questions out. I'm going to be working them out on the board. You guys give me some feedback. We're going to try to blow through this quiz because we only get an hour. Let's go.
At the beginning of the current year, trading company total assets were $250,000.
250 grand for total assets.
Right.
Okay, at the beginning of the year. All right.
His total liabilities were $178,000.
Total liabilities were $178,000.
During the year, the company reported total revenues of $99,000.
Okay, revenues were $99K.
Right.
Okay.
Total expenses $79,000.
Expenses was $79,000.
The owner withdrawals $8,000.
The owner took out $8 grand in cash. All right.
All right. And then there were no other changes in the owner capital during the year. The total assets at the end of the year were $266,000.
266,000 in total assets at the end of the year. Okay.
The company debt ratio at the end of the current year is.
What's the debt ratio at the end of the year? All right. So again, what we need to know: definitions, principles, formulas. So it told you what it's looking for: the debt ratio. So somebody give me the debt ratio. How we find that? We can simply Google it, right? Somebody Google that. Find me the debt ratio. I think I know what it is. I think it is total liabilities over total assets. Somebody give me that. And we need somebody with the calculator. Who's gonna work the calculator? Debt ratio. You should be able to just
Total
Google.
liability divided by total assets.
So total liabilities divided by total assets, that's your debt ratio. So the question told you what it was looking for. It's looking for the debt ratio at the end of the year for this company. What's the debt ratio? Total liabilities divided by total assets at the end of the year. So it's already giving us total assets for the end of the year right here. 266,000. It gave us that number. So now we need to find the total liabilities for the end of the year, right? So we got, remember the equation? What's that we need all the time? The accounting equation. The accounting equation. The accounting equation says that assets
Equal.
Go ahead.
You're gonna make me do this. I can't find it out of my
Liabilities plus equity. Good job. Good job, class. Good job. Okay? So we got assets. Boom. Right? Now we can compute equity because it gave us what? Net income. Revenues minus expenses is your net income. But we also want to take out the withdrawals from the cash that the owner took out from the equity. So calculator, let's get it. 99K minus 79K minus 8K. What did that give us?
12,000.
12,000. So 12,000 is your ending equity for this year. Equity. Okay? Did it say anything about beginning equity in the question? Did it give us beginning equity? Nope. Okay? So, now let's just find the difference. Boom. We got ending equity for the year, which is net income minus the withdrawals, leave us with 12K. So 266 K minus 12K gives us our difference that we're looking for. Total liabilities. What's that number? 254. Is that 254? Okay. So 254K is our total liabilities for the year. Okay. So now let's plug it into the formula. 254 divided by 266. No problem. Alright, so first thing they gave us was total assets at the beginning of the year, total liabilities for the beginning of the year, and total assets for the ending of the year. And then they gave us revenues, expenses, and withdrawals. So what we're looking for is the debt ratio. That's what the question asks us. What's the debt ratio? So in order to find the debt ratio, we looked up the formula. Debt ratio formula is total liabilities divided by total assets. So we had to work a little bit of math backwards to find the missing total liabilities for the end of the year. So we got 266 total assets for the end of the year. We're going to plug that at the bottom of the formula. The top of the formula is what we didn't have, total liabilities. How do we find that? By using the accounting equation. We got assets, we have equity, we subtract them to find what we missing, liabilities. Okay? So somebody plug that into the calculator. 254 divided by 266. See what we got.
954.88.
954.88 is in a decimal.
0.954.
Okay, 0.954. So what's that? 0. So this what you getting? 0.0954.
It was
0.9548.
That be good?
0.
Oh, 0 point.
Okay, so 0.954.
Yeah.
Okay, so we probably got it wrong, I think. So 95.4%. You see that, Mr. Cole? Nope, I ain't think so.
So you divided the wrong thing.
I listened to the instructor.
Total liabilities divided by total assets. So 99 minus 79, 20 minus 8, give you 12K in equity.
It'll be what? It'll be switching around. That might be it.
You know, beginning equity, what I was asking for. So, what is beginning equity? What's 250 minus 178? This is what we messed up at. 72.
Yeah.
So 72K is our beginning equity. Remember I asked Mr. Coates, did they say anything about beginning equity? Because we got to have that to add it to the ending equity. Alright, so add 72K plus 12K. Gives us what? 84K?
Yeah.
So now 84K is our equity. So what do we need to do with that number? Take it from where? 266.
84 from 266.
Take 266 minus 84K.
182.
182. So now do 182 divided by 266. 0.684. Still saying it's too big. See that, Mr. Coates? 68.4%.
No.
Nope.
Switch it around.
What if we switch it around?
66.9, 33, 49.
1.46.
Nah, no, we doing it right. Our math wrong somewhere in what we calculated our numbers to plug in to start with. So revenue, let's see here. At the beginning of the current year, the trading company's total assets were 254. Oh,
It's 254.
that's the beginning. Yeah, so that's gonna miss our number up, ain't it?
Yep.
Yep.
Let me just
Okay.
start.
Alright, let's check the rest of them. Make sure we got everything else right.
178.
So 254. Total liabilities were 178. 99 for revenue, 79 expensive, 8,000 for withdrawals. Ending assets 266. Okay, so let's see. We should be pretty close to what we need now. Alright, so we missing beginning equity. Remember, use your accounting equation to find anything that's missing. So beginning, they gave us total assets and total liability. So 254 minus 178 is 76 for beginning equity. 76,000 for beginning equity. Now we're gonna add 76K plus 12K is 88K, right?
Yep.
For equity. 88K. Now let's work backwards to get the ending liabilities, what we don't have. 266,000 ending total assets minus ending equity. So 266 minus 88 is
178.
178. Now 178 divided by 266 is point 178.
Okay, so
0.669.
0.669 should give us 66.9%. You should see that, Mr. Cole. There we go. All right, go ahead, ask your question. Tiara, right? No. Francera. Yes. All right, Francera, what you got for me?
Okay, so the dignity tax was put at 88. Okay, that's the equity. And then
Right.
what do you after that?
Okay, so we work backwards again. So they gave us the debt ratio is total liabilities divided by total assets. But these are both ending year numbers. So they gave us the ending year for total assets. So we can just plug that right in. Boom. Because they gave us that. But we do not have ending year total liability. So this is the part we had to calculate for. So in order for us to get this, we got to use the information that they gave us. They gave us the equity information. So we calculated equity. This is what we had forgot to do originally. We need beginning equity to add to the ending equity. So that's why when I was looking at it, I'm like, man, we're missing something, right? So we had to go backwards. We calculated beginning equity so we could add it to ending equity. And then we could find the missing total liability. Because now that we have our equity number, going back to this equation, so this is what it's looking like. They gave us 266, and then they gave us a little bit of equity information. But we had to work backwards to get all of the equity information. So once we got all the equity information, we got the 88K. So now we just needed to find the total liability. We subtracted those two, came up with the total liability number, and then we just plugged the formula. Make a little sense? Okay. I'm pretty sure they're going to have another one like that, so we'll get some more practice on it. I didn't mean to erase the accounting equation. All right, Mr. Coates, let's move on.
All right.
Give me 1 second. Get us a little board on. All right, so y'all kind of follow that a little bit. find the formula, use your account equation to find what's missing. All right, go ahead, Mr. Cole.
Alright, on May 31st, the cash account of bottles ROs had a normal balance of $6,400.
6,400 was in the cash account. Okay.
Alright. Thereafter, the account was debited for a total of $13,600.
Okay, the account was debited
Right.
for 13,600.
Yeah.
Okay.
$13,600.
All right. So the cash account was debited for 13,600 during that month. Debit to a cash account does what? Raise it, right? You debit cash, you sending it up. Okay, go ahead.
Credited for $12,900.
Credit it for 12,900. So we probably paid some bills. Go ahead.
What was the balance in the cash account at the beginning of May?
What was the account in the beginning? So the 6,400 is the ending for May.
Yeah.
Okay.
First.
So the 6,400 is the ending balance for May. They're asking us for the beginning balance for May. How do we find that? Right? A little bit of math. Okay, so we first got to find the activity within the month. Remember in accounting, things are journalized in the month that they happen. Okay, so during the month, we had 13,600 come in, 12,900 go out. Do that math for me. 13,600 minus 12,900. 700? Okay, so we had $700 to debit the cash account during that month, right? A net. We had a net of $700 in the cash account. So the ending balance was 6,400, right? So now, huh? How would we add it or would we subtract it? Because we want to go backwards, right? We want to go backwards. So 6,400 minus 700. 57? 5,700. See, now we can really just check that. So if we started the account with 5,700, and look, if 700 was added to that, it'll give you 6,400, which was the ending balance. So we know the beginning balance is right, 5,700. See that, Mr. Coates? Y'all get that? The 5,700 would be a debit balance. That's a debit balance in your cash account. Because anything positive in your cash account will be a normal balance, which would be a debit. So is it asking you that? Is it asking you like, is this 5,700 debit balance or?
Yeah, debit balance.
Yeah, debit balance. Debit balance. Because it's positive cash, right? Because if we was in a cash account, a credit balance would be what? Negative. There you go. Right? So we still positive. We positive. We had 5,700 to start the month. Out of all the transactions, we added a net of 700. So that left us with 6,400. So we still positive. All those numbers are positive. Those are normal debit balances.
This one got the chart on it.
Okay.
J. Brown Consulting paid $840 cash for utilities for the current month.
Okay, they paid $840,400 cash, and they paid utilities with that cash. Okay.
800 and what?
840.
840.
Yep.
Given the choices below, determine the general journal entry that J. Brown Consulting will make.
Okay.
And it says 840 cash.
So this what the company did, right? They paid in cash $840 for utility. So if you paid in cash, your cash did what?
It's dropped.
Went down.
Yeah.
How do we decrease cash? A debit or a credit? Credit, right? So we know in the answer it has to credit cash for $840. Alright, so get to all the answers with that first. We can eliminate all the rest of them.
Alright, so what side would that be?
Let me see how I'm showing it to you. Yeah, left. Yeah, so debits are on the left, credits are on the right with this. So if we are on credit and cash, then on your sheet, Mr. Coates, it should be on the left. Well, on the right. Excuse me. Because we gonna credit cash. So your cash should be on the right. You know, because we're gonna credit the cash, and then we should be debiting something else. Yep, utilities expense is definitely something we can debit. Right? So we making cash go down, we crediting cash, we making our expense what we expensed, right? We paid this bill, we saying this is, we keeping track of this utilities expense. So this is just an account that tells me how much I have paid in utilities up until this point, right? So if we pay something and we keeping track of what we paid, it's rising. You see that? See that? So that's just telling me that, let's just say at the end of the year we had paid $840 10 times, that expense account will have what? $8,400.
Yep.
See that? Yep. So see, we're gonna credit cash and we're gonna debit the expense account. What you got, Ms. Sarah? No, ask no. You got a question? Ask. Okay. So like I said, the easier way to get to that one, you know what you're gonna do to cash, right? So you can eliminate the rest of them, and then you can see what you got left and do your process elimination. But expense account, we paid a bill and then we debited the expense account because that expense account is keeping track of how much money we spent in utility, right? That's all it's doing. So we raising it. That's why it's going up, right? We spent money, so the cash going down. Okay?
You also got prepaid utilities.
Prepaid utility. It would be prepaid utilities if it was for a month that we have not used yet. Right? So if it has said we're paying utilities for all of 2019, then that's a prepaid expense. See? It's prepaid. Yeah, you paid it early. Not in advance. There you go. So as long as the question asked us, as long as it said we paid it in that month and not for something in the future, then it's not a prepaid expense. Right? Prepaid, remember language? Accounting is the business language. Remember our language. Things are just what they say. Prepaid. So if it's prepaid, it's in the future. You know, we haven't consumed it yet.
At the end of
Yeah, go ahead.
At the end of this first month of operation, Michael's Consulting Service reported net income of $32,500.
Okay, they reported $32,500 in net income.
Yeah.
That's a new question.
This is a new question, right?
Yeah.
New question.
They also had an account balance of cash, $23,000.
$23,000 in cash.
Right.
Okay.
Office supplies, $3,250.
Office supplies, $3,250. Okay.
All right. Accounts receivable, $12,500.
$12,500 for accounts receivable.
The owner's total investment for the first month was $6,250.
Okay, he invested $6,250. Okay.
Calculate the ending balance in the owner's capital account to be reported on the statement of owner's equity.
Okay. All right. So they gave us cash, which really has nothing to do with owner's equity. They gave us supplies, and then they gave us accounts receivable. So what we need over here, they gave us net income, and then they gave us how much the owner invested in the company. Right? So we're going to add those two. 38,750. Y'all agree with that? Owner's equity is net income plus or minus any additions or withdrawals of investments from the owner. So it's just like, you see that answer on there, Mr. Coates, 38,750? Okay. So it's just like I say, it's like, think about your house mortgage. If you pay your house mortgage, a portion of that goes to equity, right? That's your cash, you put it in. So they say he invested $62.50. So that's his cash. He invested that into the account. It's equity, right? It immediately goes into his equity. He invested it. It's a capital investment. Remember, all owner's equity is net income over the years, added, kept track of net income every year. Added, beginning, ended, every year. Right? So they gave us net income, and then they gave us how much he had invested. So we can add those two to get the ending equity balance for the year. Alright?
Identify the item below that would cause the trial balance to not balance.
Remember trial balance. That's what this week is kind of really all about. In addition to applying all the information from week 1, well, now we actually recording transactions. We have to figure out what the debit, what the credit, and how is it going to affect the account. So in accounting, you have something called a trial balance. So the trial balance has all of the accounts that are on the books listed in this one report. And the debits and the credits from all those accounts should always equal. Why? Because remember, in accounting, we have something called double entry. Double entry, remember? Anytime you make a accounting transaction, anytime you record an accounting transaction, you have to debit something and you have to credit something. That's a principle in accounting. Double entry. Always making 2 entries, right? So on the trial balance, it has all the accounts, right? Like all these different expense accounts, say utilities, say grass, say get your car wash expense, all these different accounts. You can find them on the trial balance. In all of those accounts, the debits and credits should always equal, right? Because of double entry accounting. So you shouldn't have any discrepancies. Go ahead with the question.
All right, the purchase of office equipment for neither answer.
Go ahead with the question. Start over.
Okay. Identify the item below that would cause the trial balance to not balance.
Okay, so they're asking us to identify the transactions that are called the trial balance not to balance. Okay, go ahead, Ms. Coates.
All right. The purchase of office equipment, $1,600.
Okay.
Was posted as a debit to office supplies and a credit to cash for $1,600.
Okay, so that should be right? We debited something and we credited something for $1,600, the same amount. It really don't even matter what accounts, right? They just asked us what would mess this up.
Yep.
So as long as we debited something and we credited something and it's the same number,
we good.
We should be good. Yeah. Keep going.
A $130 cash receipt for the performance of service was not recorded at all.
Okay, so you got a $130 cash receipt that didn't even get recorded, period. So that shouldn't mess the trial balance up because you didn't post anything to it, right? Your manager might be mad that you didn't record that sale, but you didn't post anything to the trial balance, so it shouldn't affect it. All right, keep going, Ms. Coates.
The cash payment of $910 account payable posted as a debit to accounts payable and a debit to cash for $910.
Uh-oh. We just did a transaction where we did what? Twice. You debited twice within that transaction. It don't even really matter what accounts you use. You just broke the principle of double entry. You did a debit and a debit, not a debit and a credit. So that should be wrong. All right? We're going to click that one, but I want you to go ahead and read what's left.
A $1,160 collection of account receivable was erroneously posted as a debit to accounts receivable and a credit to cash.
See? They said it was wrong, But does it mess up trial balance? Nope, because he used the same number and you debited an account and you credited an account. The trial balance, the whole purpose is the debits and the credits have to equal if we have recorded everything correctly. Okay? Y'all get that principle? The trial balance, it just got all the accounts on there, and if everything has been recorded correctly, debits and credits should equal. So go ahead, Mr. Coach. Keep us abreast on time as well.
Alright, we 30 minutes.
30 minutes? And what question are we on? Okay, so we moving. We okay though. We got more time today if we have to do the quiz over. Go ahead.
Alright, the purchase of all supplies on an account for $3,290 was erroneously recorded in the journal.
This a new question?
No, this is the last answer.
Okay, last answer. Okay, go ahead. Okay, start over with that. It said what?
The purchase of all supplies on an account for $3,290
Okay.
was erroneously recorded in the journal as $23.90 in the debit.
Okay.
To office supplies and the credit to accounts payable.
Okay. Ain't wrong with it, right, Mr. White?
Yep.
We didn't do it right, but when we posted it to the trial balance, we did use the same number.
Now it's the other, it's different number. It's $3,290.
Right, but it says we recorded it as $23.90, right?
Okay.
As a debit and a credit. Right. See, we did it wrong, but it didn't affect the trial balance because we used the same number, $23.90, and we did debit something and we did credit something. So we followed our principle, double entry. So you always know that. Never will you record a journal or a transaction and it's a debit or a credit because you're breaking the law at that point. How you doing? All right. It's time to roll right there. We're in the middle of the quiz for week 2. So just settle in and grab you some notes.
19 the answer. The one with 19?
Yeah, 19. Why? Because we debited.
Debited.
Can't do that in accounting, right? If we debit something, then we have to credit something else. So by that 910 being debit, that's wrong. We broke the laws. That are set by who? GAAP. The General Accounting Accepted Principles. That was set by the GASB, Governmental Accounting Standard Board, right? Remember, know your alphabet? Those organizations, they are the ones that make sure all of this is standardized. So no matter who or what we're looking at, we all speaking the same language. All right?
6.
Moving on to the next question. Okay?
On January 1st of the current year, Jimmy Sam's company reported owner's capital totaling at $124,500.
Okay, at the beginning of the year, owner's capital was $124,500. Okay?
During the current year, the total revenues were $99,000.
Revenues were $99,000.
While total expenses were $88,500.
Expenses were $88,500. Okay?
All right. Also, during the current year, Jimmy withdrew $23,000.
He took out $23,000. Okay?
No other changes in the equity occurred during the year. If on December 31st of the current year, the total assets are $199,000.
Total assets $199,000. Okay?
The change in owner's capital during the year was.
So the change in owner's capital during the year. Alright? So this total asset number, they just gave us information we don't need. So owner's equity statement is what? Net income, right? So net income is revenue minus expenses. Okay? So 99 is the revenue minus expenses is 88.5. But also he withdrew 23,000 directly from the profits, right? So the math is 99 minus 88.5 minus 23,000 should give us our net difference for the year. the
Negative
activity.
12,500.
How much?
Negative 12,500.
Negative 12,500.
Yeah.
Okay. And what did the question ask us, Mr. Coach, to calculate?
Oh yeah, it was the change in the owner's capital during the year.
Okay. So the change in the capital should be a negative 12,500. You see that answer?
Decrease of 12.
Decrease, right, of 12,500. Right. So remember that the three statements in accounting, you got the balance sheet, the income statement, owner's equity statement. Owner's equity is what we own, is what he's worth. So that's the net income, right? How do you get net income? Revenue minus expenses, right? That's your net income. But from that net income, he took some money, 23 more thousand. So we had to add that in there. That's how we get the negative 12,500. All right. So the owner's equity statement is the net income. It's just net income rolled over from year to year, plus or minus any investments or withdrawals. Go ahead.
Next question. On
Yes,
April
sir.
30th, Victor Services had an accounts receivable balance of $33,400.
AR balance of $33,400.
During the month of May, total credits to account receivable was $68,800.
Okay, so 68,800. Okay.
The May 31st accounts receivable balance was $27,000.
27,000 is the ending balance. Okay.
What was the amount of credit sales during May?
Okay, how many sales did we have during the month? So this is just another funky little math equation. So the beginning accounts receivable balance was 33,400. That was the beginning balance. So it's saying that we took payments of 68,800. All right. So let's minus that. So 33,400 is what we started with, minus 68,800.
Negative 35,400.
Negative $35,400.
$400.
Alright? So that would be our new sales. Right? Our net new sales for that month. But it said the ending balance is in that account receivable is 2,700. So we want to add the activity from the month to the ending balance. What's 35,400 plus 27? 35, 35, and I could be doing this wrong, but do 62,400. You see that, Mr. Cole?
62,400.
Yeah.
Yeah, that's it.
You see that? We're gonna go with that. I could be wrong though, and I'll tell you why later. But let's go with that. Alright, 62,400. Y'all see that? We just calculated the activity during the month, and then we added it to what it says the ending balance was at the end of the month. So we just was looking for the total. Activity during the month plus the ending balance. Boom. It gives you your 60, whatever that number y'all calculated. Alright, move on, Mr. Coach.
During the month of March, Hartley's Computer Services made purchases on accounting total $47,500.
Okay, we did what with the 47,500?
Made purchases on accounts total.
Okay, so we made some purchases on accounts. So that's our accounts receivable. Okay.
Also, during the month of March, Harley was paid $14,000 by a customer for services to be provided in the future.
Okay, 14,000. How much?
14,000.
Okay. Somebody gave us some money for some services that we haven't done yet, right? So you remember that? That's unearned revenue. Remember, we haven't earned that yet. That's something in the future. That's a different set of accounting rules. Okay? So that's unearned revenue. Go ahead.
And paid $38,900 of cash on his accounts payable balance.
Okay, he paid $38,900 in cash on his accounts payable. Remember what accounts payable was? Those are short-term bills, your liabilities. So that would be anything that's like not long-term. So, something you bought on credit, the light bill, mostly things that are due within 30 days or so. Accounts payable. So he lowered that account by $38,900. Go ahead.
If the balance in the accounts payable account at the beginning of March was $79,300.
Okay, so the accounts payable balance at the beginning of March was how much?
$79,300.
$79,300. Okay.
What is the balance in accounts payable at the end of March?
What is the balance in accounts payable at the end? So verify to me about this $47,500 again. What was this money?
Alright, it says during the month of March, Harley's Computer Services made purchases on accounts totaling $47,500.
Okay, so they made purchases. That's an account payable, right? So it's not money that somebody that they gave out credit for a service they provided. They bought some things on credit. Okay? So that should have been AP. That's a payables and not AR. Because accounts receivable is when you owe me money, right? I loaned you out my goods or services on credit. So I'm going to record that in accounts receivable. I'm waiting to receive it. But if you loan me services, I have to pay you. Alright? So that $47,500 is what again? Read that part again, Mr. Coates, so we want to make sure we get this right.
During the month of March, Harley's Computer Services made purchases on account totaling $47,500.
Okay, so they made purchases for $47,500. So that's gonna make payables go up, right? Then they paid $38,900 to make payables go down, right? And then they gave us the beginning balance, which is $79,300. Okay? And we looking for the ending balance. Alright? So what we need to do? What y'all think?
You need to add them,
You got to track that.
There you go. We want to find the activity for that period.
Yeah.
So $47,500, the account went up, and then $38,900, that account went down. So $47,500 minus $38,900 is $8,600. So that's the activity during the month, and then we want to add that to the beginning balance, which was $79,300. $87,900. Verify that, Ms. Coates. Okay.
So we didn't have to do anything with the $14,000.
The 14, what was that? I lost track.
That's future services.
No, because it asked us about accounts payables. It asked us about accounts payables. This is somebody gave us this money for services that we have not done yet. So that's unearned revenue. So we don't owe them. We owe them services, but it's not an account that we took out, and it's like a bill. So this is just like unearned revenue. So as of now, I don't think we don't do anything with that, but we'll find out at the end of the quiz. All right? Yes, ma'am.
I know you say you subtracted the accounts payable from cash and got the $8,600.
Mm-hmm.
And then you add that to the beginning.
Yes, ma'am.
Okay.
Okay, you see why?
So what are we trying to look for?
We looking for the ending balance in that account.
Okay.
So in that account, they gave us the activity for it. So only thing we did was find the net of the activity for that account, and then we just added it to what we started with in order to get the ending. Activity plus the balance give you the ending. Activity minus the balance will give you the beginning. Right? You subtract to go backwards, you add to go forward. Yep. So that's all we did. We took the activity and took the difference of the activity, and then we added it to the beginning in order to give us the ending. Okay? All right, go ahead, Ms. Coates.
Here's a question. Here's another chart like that. Mary Martin, the owner of Martin Consulting, started the business by investing $65,000 cash.
Oh, okay, one of those charts. I got you. Okay, so go ahead and start over.
Mary Martin, the owner of Martin Consulting, started the business by investing $65,000 cash.
Okay, he gave us $65,000 in cash. All right.
Identify the general entry below that Martin will make to record the transaction.
Okay, so we want to record this transaction. You just walked into your office, you're the accountant, right? Somebody just walked into your office and boom, say $65,000 on your desk. You have to record that money. First of all, they gave you what? Cash. In order to increase what? We would do what? In order to increase cash, we would do what? Debit or credit? Debit. Okay, so we know we're going to debit cash $65,000. All right, what is it? It's investment money, right? It's capital. The owner gave us this money for capital, right? So we would credit capital revenue or capital gains or whatever it's going to be called on now, Mr. Cole. What you see?
Say M. Martin Capital.
Call what?
M. Martin Capital.
Okay, M. Martin Capital. Just calling it the company's capital, right? So you see the debit for $65,000, right? On the left side this time, right? And then we credited the revenue account on the right side for $65K, right? Y'all see that? So all we doing is just recording cash. Somebody walked in the office, they say, here you go, $65,000. Your manager say, hey, record that cash to the general ledger, right? The general ledger is the place that the journal entries go. So you would make a journal entry recording that $65,000. So what account are we gonna debit? Cash. It's cash, right? So that's all we doing now. We just deciding what account to put things in, and it's just like they sign. Somebody give you cash, it goes in the cash account. If you owe somebody, it's a payable. You got to pay them. If somebody owe you, it's a receivable. You waiting to receive it, right? So keep going, Mr. Coates. Let's slide on.
We're on number 10.
Okay. 10, 12 minutes. We at least got to get to 15.
All right. We received graphic design. Received $1,600 from the client via the previous month for services provided.
So they received $1,600.
Here's another chart.
Okay. They received $1,600 for some services that they had already billed in the previous month. Okay. So boom, somebody just paid us. Our accounts receivable account. We just received some money. It wasn't cash, right? Well, it is cash, but it going to accounts receivable as well. So did they pay us in cash? It says that, or is it like $, something like that? Okay. Just go ahead and keep reading the question.
That was it.
Okay, so it says just paid us in $1,600 accounts receivable.
All right. Which of the following general entry will Trump design make to record this transaction?
Okay, so if they paid us $1,600 and we know this money goes in accounts receivable because we've been waiting on it. It's something we did for them in the past, right? So if they paid us in this accounts receivable account, are we trying to increase this account or decrease this account? They just paid us.
Oh, we
Decrease, right? Because this is money people owe us. Accounts receivable. So this is money people owe us. So if somebody paid their bill then we have to decrease that account, right? Because now they don't owe us as much anymore, right? So we would do what to decrease the account receivable account? Debit or credit? Credit it. There you go. So we know, Mr. Coates, that we're going to credit accounts receivable. That's going to be on the right? Because we decreasing our accounts receivable account, and then they gave us cash. We're going to assume, maybe it was a check, whatever, but that's just like cash or a credit card. So we will increase cash. That would be a debit to our cash account. So we would debit cash, credit accounts receivable. See that, Mr. Scopes, on that? Okay. All right, let's move on.
Next question. Andrea Apple open.
Let me know when we get to 5 minutes, Mr. Scopes.
Andrea Apple opened Apple photography on January 1st, the current year. In January, the following transactions occurred and were recorded in company books. Number one, Andrea invested $13,600 in cash to the business.
Okay, she gave us $13,600 in cash. All right. Owner's investment. Go ahead.
All right. She gave $21,000 for equipment.
She gave us $21,000 in equipment. Or did she buy equipment, or she gave us $21,000 worth of equipment?
Saying Andrea contributed $21,000 of photography equipment to the business.
Okay, so she gave us $21,000 worth of photography equipment. Okay, so in that cash, she gave us some property. Okay, all right, go ahead.
The company paid $2,200 cash for insurance policy.
Okay, we paid $22,000. $2,200 cash for insurance policy that's gonna cover us for the next 24 months. Right. Okay, that's a prepaid expense. Keep that in mind. Remember, anything prepaid is a different set of rules. Go ahead.
All right. The company received $5,800 cash for services provided during January.
Okay, we got $5,800 for some sales. All right.
All right. The company purchased $6,300 of office equipment on credit.
Okay, $6,300 on credit. We bought some equipment, then use cash. We use credit. Go ahead.
The company provided $2,850 of services to customers on account.
Okay, so we did $2,850. All right, we loaned out some services, right? Accounts receivable. They didn't pay us for it. They got to pay us later. All right, go ahead.
The company paid cash $1,600 for monthly rent.
Okay, we paid out $1,600 for the rent. Okay.
All right, the company paid $3,200 on office equipment purchase in transaction number 5, which is $6,300.
Okay, we paid on that bill a little bit. $3,200. All right.
All right, paid $250 cash for January utilities.
$250 cash.
$285. I'm sorry.
200 and what?
$285.
Okay.
Cash.
Okay.
For utilities.
For utilities. Okay. What else you got?
Right. Based on the information, the balance in Apple Capital account reported on the statement of owner's equity at the end of the month would be.
Okay, we're looking for the balance on owner's equity at the end of the month. Okay. So we have to go back through this. 21,000 was what?
Equipment
Equipment.
that was given to.
That right. So okay, so we know that don't affect owner's equity. Okay. 2,200 was cash paid for prepaid insurance. I'm not sure about that. I'm not gonna add that right now, but let's just put a star by that because that may go in there. All right, and then we got 6,300 was well, we bought that on credit, right? So we know that don't affect owner's equity. It's not cash and anything like that. And then we had what's the 1,600? Is that what this problem?
Rent expense. That's a rent expense.
Okay, I got that over there. We know we need that. 2,850 was services we loaned out, right? So we didn't receive. That's not. Yeah, we didn't receive that yet. Okay. So we looking for owners. How you doing, man? We looking for owners equity. So again, the owner's equity report is net income, revenue minus expenses, plus or minus any withdrawals or investments. So 13,600 was the right. So we know that go in right. Owner's equity, net income, plus or minus. Okay, plus or minus any withdrawals or investment. So 3,600 goes. 5,800 was.
For services in January.
We revenue, right? So we know that go revenue minus expenses, okay? 1,600 rent expense. 3,200 is we paid, so that's an expense, right? And then 285 is an expense, right? And then so the only one was in question was that prepaid insurance. It's asking me about owner's capital, not the cash flow report, so I'm not gonna add that. So y'all give me that 13,600 plus 5,800 minus 1,600 minus 3,200 minus 285.
14,315.
14,315. See that, Mr. Coach? So add the 2,200. No, you're gonna minus it because we paid it, right? So minus.
1,115.
You see that one either? All right, just pick something and move on.
Pick the right answer, Mr.
Now, it's gonna give us the answer when we done, so it don't even matter.
At the beginning of
What number we on?
we're on 12.
We on 12. We trying to get to 15. Go ahead.
At the beginning of January return year, Little Mike Educator and Lizard reflected the normal balance of $65,000 for accounts receivable. In January, the company collected $17,400.
Just go ahead and click through. Just click through. Yeah, just click through. We gonna get to the end. Because we only got 3 minutes. Since mine had the following accounts and balances at this time, roll calculated account for and then income, so that would just be revenue minus expenses. Just go ahead and click through. Got 2 minutes.
Karen, you got your notes for chapter 2.
We have,
You take notes.
we're doing the quiz. That's all we've done.
Did you take notes for the quiz?
I'm doing it now. Yeah.
Or you didn't take your notes on the side?
I'm just doing the problem.
We about to go back through it. What time is it?
7.
7?
Mm-hmm.
Okay.
Like 3.
Oh, I didn't.
Hey, Charles.
Let's get this one right. That's the easy one. Says GG dash studio provide 310 dash instruction and rent it out his dash studio to the side defined for another 180. So that's 490. The client paid immediately, so that's cash. So what was that? Dash studio renting it out for 180 and then class was 310, so 8.
So we on chapter.
You see that? Collected 490
We're number 12.
cash. How much time we got? Somebody got time to do that. 20 seconds after you.
First meeting.
Yep.
Are you not gonna do, I mean, you should do like online.
Pretty much what
You should do it
chapter
online.
one was about.
Okay. Alright. So we're gonna go through.
I don't know when you have to come in.
Go through.
I didn't like it.
Go through.
See, I got you back there, so I'm fine.
Alright, stop right there. We got one wrong. Number 9.
Yeah, I'm.
Alright, so Mary Martin, the owner of Martin Consulting. 65,000 in cash. Up. Yeah. Okay, so we did get that. You just chose the wrong one. So just choose the right one, man. Then just move on. We ain't gonna waste time explaining that one. Okay. Okay, we got that one wrong. Alright, so let's see what we got right here. 41,365. Alright, let's do that one. And you scroll down, it should give you how, what's to see that. See, so it's gonna tell you what you should have did. Alright, so let's rework that one. Alright, Mr. Coates, that's number what?
11.
Number 11. We got one wrong. Alright, start off, what's that question?
Andrea Apple opened an Apple photography January 1st. During January, the following transactions occurred. Number 1, Andrea invested $13,600 cash in the business.
Okay, she invested $13,000. Marker going up. 13,600. Okay.
All right. Andrea contributed $21,000 of photography equipment.
Okay, she contributed $21,000 in equipment.
That's the same one.
Yeah, this is what we're doing.
Yeah.
Alright.
All right. The company paid $2,200 for insurance for the next 24 months.
Paid $2,200 in insurance. That's about gone, man.
You don't, we cannot see that.
Y'all gonna have to write it yourself. Maybe I do it soft.
Why don't they have another one in the drawer over there, friend?
Right, let me check. Alright. Let's see. That's it. We wrote up the whole board. Nope. Y'all just gonna have to listen to Mr. Coates.
We got it written down already, so that's that same one.
Right.
The last one we did.
So let's just go through it. Alright. So she invested $13,000 in the business. That go. Oh, so they added the $21K of photography equipment to the business. Plus cash flow provided. So the equipment goes into that formula. Plus 58 cash for services. We know the revenue goes. Minus 28 services to the customers on account. Okay, so they were right. We got to record that revenue because it's already earned. Minus 1,600 for rent. Minus 285. Okay, so what didn't go? 13, 21. Did that 22 go? Nope, I figured it didn't. On prepaid, because it's a prepaid expense. So we haven't actually incurred it yet. So y'all get that on prepaid? When we got prepaid revenue or prepaid expenses, they haven't actually happened yet. So they don't go into the owner's equity statement because they haven't been incurred yet. It's prepaid. We're waiting to record it. So that 2,200 I was debating on, so it didn't go because it was a prepaid expense, right? Everything else goes into the formula. So the formula should have been, all right, so it says Andrea Apple opened Apple Photography on January 1 of the current year. During January, the following transactions occurred and were recorded in the company's books. Andrea invested $13,600 cash in the business, so we know we're gonna add that, right? She invested $13,600. She contributed $21,000 in photography equipment. So I was thinking that didn't go because it was cash, but because that's an asset, it's recorded into this formula. Okay, so 21,000 go into it. So 13,600 plus 21,000. We received 5,800 in cash for services provided as revenue, right? You know revenue go. Revenue minus expenses. So plus 5,800, 28,500 is we provided 22,850 of services on credit. So they didn't actually give us the money, but we earned the revenue. Remember, we have to record things when they are earned. So even though they paid that 28,500 on credit, we still have to add it as if we actually got paid that cash because we earned it. Yeah. Now, if they had paid us for that for something in the future, then we wouldn't add it, right? Because we haven't rendered the services yet. It's a prepaid, right? Prepaid versus right now. Prepaid versus right now. Okay? And then minus 1,600 was the rent expense. You know that goes, right? Minus 1,600, you paid your rent. Minus 285, you paid in utility. So your answer should have been $41,365. So the only thing that didn't go into that formula was that 2,200 that we were talking about, because it was a prepaid expense. Because it was something that we haven't actually expensed right now. Okay, got that one. What was that one? This one, we probably start choosing stuff. Okay, so let's do this one. Net income. Okay, so net income is just what? Revenues minus expenses. So I'll let you, Mr. Coates. You give me the numbers. You tell me which numbers go, which numbers stay. So we're going to do all our revenues first, right? So on that statement that you're looking at, we calculated net income. So the formula for net income is revenues minus expenses. So give me all the revenues.
All right, 10,700, 10,700.
10,000. I guess I might as well give up. Huh?
Look,
I thought if I did it softer, it might work. Alright, that's so. So, Mr. Coach's screen is getting recorded as well. So, you guys will get a chance to see this exact quiz with the answers and, what the answer was, what it should have been. Okay? So, I'm just upload that for y'all to see. Alright? So, Smiles Entertainment had the following accounts and balances at December 31st. So cash, 10,700. So let's just go down. So, like I said, net income is revenues minus total expenses. So service revenue minus salary expenses minus utility expenses. So this is all you want to do. You just go through here and find the revenue. Cash is cash, accounts receivable, prepaid insurance, supply, accounts payable, T-Happy Capital. So service revenue, they gave you the revenue, 7,700. Minus expenses, salaries, 57, utilities, 1,140. Yeah. 77 minus 57. minus 1140. So that's all that question I'm asking you to do. Got my pen on it. So net income, revenue minus expenses. Revenues minus expenses is net income. That's all that question is asking. So just click all through. Let's see what else is asking now. Credit purchase of new 5200 was posted to kitchen equipment. That's a 5200 debit into accounts payable. Which is 200 debit. What error would this have on trial balance? Right. So trial balance. Y'all remember that? Trial balance? Trial balance, the debits and the credits have to equal. The trial balance is just a conglomerate of all the accounts for that company on that particular statement, which is called the trial balance. So this question says that the credit purchase of a new oven for $5,200 was posted to kitchen equipment as a $5,200 debit and to accounts payable as a $5,200 debit. So you see what they did wrong? Two debits, right?
They can't have two of the same, they have one credit, one debit.
Can't have two of the same. Accounting says we have a principle called double entry, right? If you debit something, you have to credit another account. So the answer can never be debit or credit, right? So why though, Mr. Coates, is it not just $5,200 over, but double that, 10,400?
You did the same number on the same side.
Did the same number on the same side. There you go. Just simple mathematics. Right? I wish I could see this quiz, Mr. Coates getting a little bit extra session in. So just click the right one too. So when they go back and see it, they can see it. At the end of the current year, Lear Company reported total liabilities of $303. Alright, somebody work this. Y'all work this one. Okay? At the end of the current year, Lear Company reported total liabilities of $303,000. Alright? So at the end of the year, total liabilities is $303,000. Okay? Total equity is $103,000. Right? At the end of the year. The company's debt ratio on the last year end was. Okay? So the debt ratio is what? Total liability divided by total assets. So they gave us what? Total liabilities. We have that number. $303,000 in the year, right? End of the current year. And then end of the current year. Okay? So we missing what? Total assets. We have to use what to find the missing number? The accounting equation, right? So assets is always equal to liabilities plus equity. So they gave us liabilities and equity. So we know assets by doing what?
Subtracting, so it's going to be $200,000 in assets.
You're going to add them. Yeah. Right? You got, remember the accounting equation? It's assets is equal to liabilities plus equity. So we're missing assets. They gave us liabilities and equity. So liabilities plus equity would be equal assets. So what's that number? 406,000. Alright, so yep. Liabilities divided by assets. So 303,000 divided by 406,000 is 74.6%. See that, Mr. Coach? Yep. So y'all see that? Remember your counting equation. Assets is equal to liabilities plus equity. You plug in the information you got, and then you do the math for the information you don't have. Okay? So if they had given us assets, and we were looking for liabilities and we had equity, we would subtract. There you go. Right? So they gave us liabilities and equity, so we just add them to get assets. And now we have all the information we need, plug it into the form. Alright, go ahead. You sign row. Okay. So for the first week, what did you make on your quiz? You did 9. Okay, good. So everybody's gonna get a 95, the grade that my 8 o'clock class got. Because we got through the quiz, and so it'll be the same thing this week too. So I want y'all to still attempt it, but I'll still gonna give y'all the grade that I get in the morning, because I get through it with them, because we done went through it. So it's not, it ain't real fair. That's a good job.
Well, the first time I made a 60, and then I retook it.
That's a good job. Good job.
They like the kind of quiz that you need an hour. We need like 2 3
They are, an hour is short. Because I started doing this one before I was trying to come to class, and I didn't get through it.
Well, I only got one.
Yeah.
On mine.
What you have, baby?
I can give you one attempt. You have to email me, and no, everybody have. I already have it.
Yeah.
I got 2.
It wasn't on there yesterday.
You should have 2.
Took mine Sunday and it was only one there. On
Yeah.
Sunday.
I took my Monday.
So, but normally how it's gonna go, when we do it, a quiz in class, you don't go home and do it.
No.
Right? Because your grade gonna go in,
Already.
and then I got to do, extra process to get that grade out and put our class grade in. But this week, I do want you to attempt it, right? Because we didn't get all the way through it, so I still want you to attempt it, right? So you can, learn the information, make sure you know the information.
That's right.
But I'm gonna give y'all the same grade that I get in the morning at 8 o'clock, right? Okay?
Unless it's a failing grade, and then we'll do it again over here.
Right. We gonna hope we don't fail after all this prep work.
I'm talking about your morning class.
Right. All right. So that's how. So like I said, going forward though, if we do it in class now, the next week is gonna be your grade, right? But the following week, I'll probably do another in class. Okay. All right. So cool.
Yeah.
Okay. All right. So everybody got a 95 the first week. You probably get a 95 this week, maybe.
Then you gotta do your own thing.
You gotta do your own that week, third week, right? We gotta be a little bit accommodated, learn the information, right?
Yeah.
And then we see where we at. Okay.
Right.
Other than that, we want you to stay up top of the grade. Your homework assignments and your discussions for the week. So keep in mind again, your first post for your group discussions is due by Wednesday. You're supposed to have responded to 2 classmates by Friday. Okay? Your homework assignment is supposed to be, your homework and your weekly project is supposed to be done by Saturday. And then your quiz is supposed to be in by Sunday. Okay?
Do you really know how to sound? As long as you have everything in by the end of the week?
As long as you have everything in by the end of the week.
semester.
No, I can't go back that far. I want y'all, of course I work with you, but I can't say that that's how I want it done. I would like for us to stay current and up to date as much as possible. Right? But I work with you, of course. I'm not saying that I won't, but I do want us to stay current and up to date. We trying to, make it as easy for you as possible. Okay? So I do want you to stay up to date. So if we're going to do a major part in class, right? Your group discussions is like 20%. When you look at your syllabus, these quizzes is like 20%. Attendance is like 20%. That's over half of your grade right there. The homework is basically just clicking through, right? The weekly project is 1 page. You see what I mean? It should be no way. You got to just not want to pass. Okay? And make a good grade. I want you to make a good grade. Okay? But I can't give it to you. But I will do everything to make it as easy as possible. But we got to learn information. I want you to know about accounting. you business students, and accounting is the business language. So we want to know the information.
Okay.
So that is the question. Ready when you ready, Mr. Coach. Fire away. Alright, it's your lesson 2 quiz. Week 2, lesson 2. The lesson for this week is about the trial balance. So we're going to go through the trial balance, also making journal entries. So a lot of the fundamental principles and things that we did last week about what's the debit, what's the credit, how does it affect assets, how do it affect liabilities. So now we're actually recording some transactions, like if you were actually an accountant for a business or a firm. So go ahead and get us started, Mr. Coach. Mr. Coach is our quiz taker for today, so he's going to be reading the questions out. I'm going to be working them out on the board. You guys give me some feedback. We're going to try to go through this quiz because we only did an hour. Let's go.
At the beginning of the current year, trading company total assets was 250,000.
250 grand for total assets.
Right.
Okay, at the beginning of the year. All right.
Its total liabilities were 178,000.
Total liabilities were 178,000.
During the year, the company reported total revenues of 99,000.
Okay, revenues were 99K.
Right.
Okay.
Total expenses 79,000.
Expenses was 79,000.
The owner withdrawals 8,000.
The owner took out 8 grand in cash. All right.
Alright, and then there were no other changes in the owner capital during the year. The total assets at the end of the year were 266,000.
266,000 in total assets at the end of the year. Okay.
Company debt ratio at the end of the current year is.
What's the debt ratio at the end of the year? All right. So again, what we need to know: definitions, principles, formulas. So it told you what it's looking for, the debt ratio. So somebody give me the debt ratio. How we find that? We can simply Google it, right? Somebody Google that. Find me the debt ratio. I think I know what it is. I think it is total liabilities over total assets. Somebody give me that. And we need somebody with a calculator. Who's going to work the calculator? Debt ratio. You should be able to just
Total
Google.
liability divided by total assets.
So total liabilities divided by total assets, that's your debt ratio. So the question told you what it was looking for. It's looking for the debt ratio at the end of the year for this company. What's the debt ratio? Total liabilities divided by total assets at the end of the year. So it's already giving us total assets for the end of the year right here. 266,000. It gave us that number. So now we need to find the total liabilities for the end of the year. Right? So we got, remember the equation? What's that we need all the time? The accounting equation. The accounting equation. The accounting equation says that assets
Equal.
Go ahead.
You're gonna make me do this. I can't find it out of the wall.
Liabilities plus equity. Good job. Good job, class. Good job. Okay? So we got assets. Boom. Right? Now we can compute equity because it gave us what? Net income. Revenues minus expenses is your net income. But we also want to take out the withdrawals from the cash that the owner took out from the equity. So calculator, let's get it. 99K minus 79K minus 8K. What did that give us?
12,000.
12,000? So 12,000 is your ending equity for this year. Equity. Okay? Did it say anything about beginning equity in the question? Did it give us beginning equity? Nope. Okay? So, now let's just find the difference. Boom. We got ending equity for the year, which is net income minus the withdrawals, leave us with 12K. So, 266 K minus 12K gives us our difference that we're looking for, total liabilities. What's that number?
254.
Is that 254? Okay. So 254K is our total liabilities for the year. Okay. So now let's plug it into the formula. 254 divided by 266.
What we just did, I got lost.
No problem. Alright, so first thing they gave us was total assets at the beginning of the year, total liabilities for the beginning of the year, and total assets for the ending of the year. And then they gave us revenues, expenses, and withdrawals. So what we're looking for is the debt ratio. That's what the question asks us. What's the debt ratio? So in order to find the debt ratio, we looked up the formula. Debt ratio formula is total liabilities divided by total assets. So we had to work a little bit of math backwards to find the missing total liabilities for the end of the year. So we got 266 total assets for the end of the year. We're going to plug that at the bottom of the formula. The top of the formula is what we didn't have, total liabilities. How do we find that? By using the accounting equation. We got assets, we have equity, we subtract them to find what we're missing, liabilities. Okay? So somebody plug that into the calculator. 254 divided by 266. See what we got.
954.88.
954.88 is in the decimal.
0.954.
Okay, 0.954. So what's that? 0. So this what you getting? 0.0954.
It was 0.9548.
That what you got?
0.
Oh, 0 point.
Okay, so 0.954.
Yeah.
Okay, so we probably got it wrong. Okay. So 95.4%. You see that, Mr. Cole? Nope, I didn't think so.
So you divided the wrong thing.
I listened to the instructor.
Total liabilities divided by total assets.
What's your two numbers?
So 99 minus 79, 20 minus 8, give you 12K in equity.
Huh? It'll be what? It'll be switched around?
1.02.
That might be it.
Beginning equity, what I was asking for. So, what is beginning equity? What's 250 minus 178? This is what we messed up at.
Oh.
72.
72.
Yeah.
So 72K is our beginning equity. Remember I asked Mr. Coates, did they say anything about beginning equity? Because we got to have that to add it to the ending equity. Alright, so add 72K plus 12K. Gives us what, 84K?
Yeah.
So now 84K is our equity. So what do we need to do with that number? Take it from where? 266.
84 from 266.
Take 266 minus 84K.
182.
182. So now do 182 divided by 266. .684. Still seems too big. See that, Mr. Coach? 68.4%. No.
Switch it around.
What if we switch it around?
$66.9.
1.46.
Nah, we doing it right. Our math wrong was somewhere in what we calculated our numbers to plug in to start with. So revenue, let's see here. At the beginning of the current year, the insurance company's total assets were 254. Oh,
It's 254.
that's the beginning. Yeah, so that's gonna miss our number of payments.
Yep.
Yep.
Let me just
I'm
start.
not long.
That's why my pencil.
Alright, let's check the rest of them. Make sure we got everything good. Right.
178.
So 254. Total liabilities were 178. 99 for revenue. 79 expenses. 8,000 for withdrawals.
Still comes up.
Any assets 266. Okay, so let's see. We should be pretty close to what we need now. Alright, so we missing beginning equity. Remember, use your accounting equation to find anything that's missing.
Yeah.
So beginning they gave us total assets and total liability. So 254 minus 178 is
76.
76 for beginning equity. 76,000 for beginning equity. Now we're gonna add 76K plus 12K is 88K, right?
Yep.
For equity. 88K. Now let's work backwards to get the ending liabilities, what we don't have. 266,000 ending total assets minus ending equity. So 266 minus 88 is
178.
178. Now 178 divided by 266 is point 178.
Okay, so
0.66. 0.669.
0.669 should give us 66.9%. Should see that, Mr. Cole. There we go. All right, go ahead, ask your question. Tiara, right?
Yeah.
No. Francella.
Yeah.
Yes. All right, Francella, what you got for me?
Okay, so the 76K was to a case 88. Okay, that's the equity. And then
Right.
what you did after that?
Okay, so we work backwards again. So they gave us the debt ratio is total liabilities divided by total assets. But these are both ending year numbers. So they gave us the ending year for total assets. So we can just plug that right in. Boom.
But after that,
Because they gave us that.
260.
But we do not have ending year total liabilities. So this is the part we had to calculate for. So in order for us to get this, we got to use the information that they gave us. They gave us the equity information.
Yep.
So we calculated equity.
Yep.
This is what we had forgot to do originally. We need beginning equity to add to the ending equity.
Gotcha.
So that's why when I was looking at it, I'm like, man, we're missing something, right? So we had to go backwards. We calculated beginning equity so we could add it to ending equity, and then we could find the missing total liability. Because now that we have our equity number, going back to this equation, so this is what it's looking like. They gave us 266, and then they gave us a little bit of equity information. But we had to work backwards to get all of the equity information. So once we got all the equity information, we got the 88K. So now we just need to find the total liability. We subtracted those two, came up with the total liability number, and then we just plug the formula. Make a little sense? Okay. I'm pretty sure they're going to have another one like that, so we'll get some more practice on it. I didn't mean to erase the accounting equation. All right, Mr. Coach, let's move on.
All right.
Give me 1 second, get us a little board on. All right, so y'all kind of follow that a little bit. Find the formula, use your accounting equation to find what's missing. All right, go ahead, let's go.
Alright, May 31st, the cash account of Balthazar Arhus had a normal balance of $6,400.
6,400 was in the cash account. Okay?
Alright. During May, the account was debited for a total of $13,600.
Okay, the account was debited
Right.
for 13,600.
Yeah, $13,600.
All right. So the cash account was debited for 13,600 during that month. Debit to a cash account does what? Raise it. Right? You debit cash, you sending it up. Okay, go ahead.
And credited for $12,900.
Credited it for 12,900. So we probably paid some bills. Go ahead.
What was the balance in the cash account at the beginning of May?
What was the account in the beginning? So the 6,400 is the ending for May?
Yeah.
Okay. So the 6,400 is the ending balance for May. They're asking us for the beginning balance for May. How do we find it? Right? A little bit of math. Okay, so we first got to find the activity within the month. Remember in accounting, things are journalized in the month that they happen. Okay, so during the month, we had 13,600 come in, 12,900 go out. Do that math for me. 13,600 minus 12 down.
700.
700?
Mm-hmm.
Okay, so we had $700 to debit the cash account during that month, right? A net. We had a net of $700 in the cash account. So the ending balance was 6,400, right? So now, huh?
Add those two.
6,407.
How would we add it or would we subtract it?
Oh, subtract.
Because we want to go backwards,
Okay.
right?
Okay.
We want to go backwards.
Got it.
So 6,400 minus 700.
51? No.
It's 57.
5,700.
5,700. See, now we can really just check that. So if we started the account with 5,700, and look, if 700 was added to that,
64, yeah.
it'll give you 6,400,
Yeah.
which was the ending balance.
Yeah.
So we know the beginning balance is right, 5,700. See that, Mr. Coates? Y'all get that?
I got
That'd
it.
be credit or debit?
The 5,700 will be a debit balance. That's a debit balance in your cash account. Because anything positive in your cash account will be a normal balance, which would be a debit. So is it asking you that? Is it asking you like, is this 5,700 debit balance or?
Yeah, debit balance, credit balance.
Yeah, debit balance. Debit balance. Because it's positive cash, right? Because if we was in a cash account, a credit balance would be what?
Negative.
Negative. There you go. Right? So we still positive. We positive. We had 5,700 to start the month. Out of all the transactions, we added a net of 700.
Yeah.
So that left us with 6,400. So we still positive. All those numbers are positive. Those are normal debit balances.
Alright, this one got a chart on it.
Okay.
J. Brown Consulting paid $840 cash for utilities for the current month.
Okay, they paid $840,400 cash, and they paid utilities with that cash. Okay?
How much? 800 and what?
840.
840.
Yep.
Given the choices below, determine the general journal entry that J. Brown Consulting will make.
Okay.
And it says $840 cash.
So this what the company did, right? They paid in cash $840 for utility. So if you paid in cash, your cash did what?
It dropped.
Went down.
Yeah.
How do we decrease cash? A debit or a credit?
Yeah.
Credit, right? So we know in the answer, it has to credit cash for $840.
Yeah.
All Alright, so get to all the answers with that first. We can eliminate all the rest of them.
Alright, so what side would that be on the left front?
Let me see how that's trying to tell you. Yeah, left. Yeah, so debits are on the left, credits are on the right with this. So if we are on credit and cash, then on your sheet, Mr. Coates, it should be on the left. Well, on the right.
Yeah. That one I ain't over.
Because we don't credit cash.
That's why I look back
So
at
your cash should be on the right.
Yep.
You know, because we're going to credit the cash, and then we should be debiting something else.
Utilities expense.
Yep, utilities expense is definitely something we can debit. Right? So we making cash go down, we crediting cash, we making our expense what we expensed, right? We paid this bill, we saying this, we keeping track of this utilities expense. So this is just an account that tells me how much I have paid in utilities up until this point, right? So if we pay something and we keeping track of what we paid, it's rising.
Yeah.
You see that?
You're right.
See that? So that's just telling me that, let's just say at the end of the year we had paid $840 10 times, that expense account will have what? $8,400.
Yep.
See that?
Yep.
So see, we're gonna credit cash and we're gonna debit the expense account. What you got, Ms. Spencer?
I feel you going
No, ask, no. You got a question?
now.
Ask. Okay. So like I said, the easier way to get to that one, you know what you're going to do to cash, right? So you can eliminate the rest of it. And then you can see what you got left and do your process elimination. But expense account, we pay the bill and then we debit the expense account because that expense account is keeping track of how much money we spent in utilities, right? That's all it's doing. So we raising it. That's why it's going up, right? We spent money, so the cash going down. Okay?
You also got prepaid utilities.
Prepaid utilities. It would be prepaid utilities if it was for a month that we have not used yet. Right? So if it had said we're paying utilities for all of 2019, then that's a prepaid expense. See? It's prepaid. Yeah, you paid it early.
In advance.
Not in advance. There you go. So as long as the question asked us, as long as it said we paid it in that month and not for something in the future, then it's not a prepaid expense. Right? Prepaid, remember language? Accounting is the business language. Remember our language. Things are just what they say. Prepaid. So if it's prepaid, it's in the future. You know, we haven't consumed it yet.
At the end of
Yeah, go ahead.
At the end of his first month of operation, Michael's consulting service reported net income of $32,500.
Okay, they reported $32,500 in net income.
Yeah.
That's a new question.
This is a new question, right?
Yeah.
New question.
They also,
Yeah.
they also had an account balance of cash, $23,000.
$23,000 in cash. Okay.
Office supplies, $3,250.
Office supplies, $3,250. Okay.
Accounts receivable, $12,500.
$12,500 for accounts receivable.
The owner's total investment for the first month was $6,250.
Okay, he invested $6,250. Okay.
Calculating the ending balance in the owner's capital account to be reported on the statement of owner's
Equity. Okay. All right, so they gave us cash, which really has nothing to do with owner's equity. They gave us supplies, and then they gave us accounts receivable. So what we need over here, they gave us net income, and then they gave us how much the owner invested in the company, right? So we're going to add those two. 38, 750.
Yeah.
Y'all agree with that?
I got it.
Owner's equity is net income plus or minus any additions or withdrawals of investments from the owner. So it's just like, you see that answer on there, Mr. Coates, 38,750? Okay. So it's just like I say, it's like, think about your house mortgage. If you pay your house mortgage, a portion of that goes to equity, right? That's your cash, you put it in. So they say he invested $6,250. So that's his cash. He invested that into the account. It's equity, right? It immediately goes into his equity. He invested it. You know, it's a capital investment. Remember, all owner's equity is net income over the years, you know, added, kept track of it. Net income every year. Added, beginning, ending, every year. Right? So they gave us net income, and then they gave us how much he had invested. So we can add those two to get the ending equity balance for the year. Alright?
Identify the item below that would cause the trial balance to not balance.
Remember trial balance. That's what this week is kind of really all about. In addition to applying all the information from week 1, well, now we actually record the transactions. We have to figure out what the debit, what the credit, you know, and how is it going to affect the account. So in accounting, you have something called a trial balance. So the trial balance has all of the accounts that are on the books listed in this one report. And the debits and the credits of all those accounts should always equal.
Yeah.
Why? Because remember in accounting, we have something called double entry. Double entry, remember? Anytime you make a accounting transaction, anytime you record an accounting transaction, you have to debit something and you have to credit something. That's a principle in accounting, double entry. Always making 2 entries, right? So on the trial balance, it has all the accounts, right? Like all these different expense accounts, say utilities, say grass, say get your car wash expense, you know, all these different accounts. You can find them on the trial balance. And all of those accounts, the debits and credits should always equal, right? Because of double entry accounting. So you shouldn't have any discrepancies. Go ahead with the question.
All right, the purchase of office equipment for either answer.
Go ahead with the question. Start over.
Okay. Identify the item below that would cause the trial balance to not balance.
Okay, so they're asking us to identify the transactions that are called the trial balance not to balance. Okay, go ahead, Ms. Coates.
All right, the purchase of office equipment for $1,600
Okay.
was posted as a debit to office supplies and a credit to cash for $1,600.
Okay, so that should be right? We debited something and we credited something for $1,600, the same amount. It really don't even matter what accounts, right? They just asked us what would mess this up.
Yep.
So as long as we debited something and we credited something and it's the same number,
we good.
We should be good.
Yep.
Keep going.
All right. A $130 cash receipt for the performance of the service was not recorded at all.
Okay, so you got a $130 cash receipt that didn't even get recorded, period.